So here's what you do if you think there might be a problem with your employee retention tax credit filing. So the first thing is don't panic. Before you do anything, it's really important that you don't make the problem worse and that you take the time to really understand what the problem is. So in doing a review of employee retention tax credit filings, there's kind of two sides to the process that we look on. Number one is, was the credit calculated correctly? And number two is, do we have a reasonable basis to support the filing of the credit? So on step one, what we would do is we would go through all of the documents, pretend basically it's a brand new credit, and would go through and audit that process. We want to make sure that all of the qualified wage calculations and all the credit calculations were performed correctly. And so absent any work papers from the organization that prepared your employee retention tax credit, we would essentially go back through and do kind of a re-audit of the math to make sure that everything was calculated correctly. Problem number two is going through and looking at the substantiation or the underlying merit of the claim that the employee retention tax credit was based on. And so in looking at the underlying merit, what we're tracing is, do we either have a valid argument under the gross receipts test, or can we prove that under the operational impact test, we have a more than nominal impact based on a government order? So on the gross receipts side of things, because it's a comparative analysis, we're looking basically at gross receipts for a quarter in 2019 versus a quarter in 2020 or 2021. On the operational impact side of things, the first place we start is with the impact to the business. So going through quarter by quarter, we want to really make sure that we have the impact to the business documented and that impact was more than nominal. And so the first place we start is in the earlier quarters, mainly second quarter of 2020. Impact is usually the easiest to establish in the early quarters because it was the early days of the pandemic. So that's traditionally we're going to see lots of your shutdown orders or stay-at-home orders, or a lot of the more serious orders will happen in March, April, May, June of 2020. As you move through 2020, depending on the state that you're in, the orders may get more restrictive or they may get less restrictive. So if you remember in late 2020, we had the Delta variant. So particularly in fourth quarter of 2020, you'll see orders spike in a particular quarter around dealing with preventative measures for Delta. As you move into 2021, that's when the vaccine started rolling out, particularly towards the end of first quarter 21. And so you'll see a series of orders around the vaccine. Not to make any political biases, but states that tend to be more politically conservative or tend to be Republican states tend to have less stringent government orders in place than Democratic states or blue states. In particular, the IRS is probably going to scrutinize the second quarter and the third quarter of 2021 because those two periods were post-vaccine. And so as a result, you're going to see fewer government orders in place and you're going to see fewer examples of impact that's more than nominal on businesses. That's not going to be the same for every business, and certainly in certain places, most notably Los Angeles, San Francisco, New York, larger major metropolitan areas, you're going to still see a restrictive environment. But even so, for the broader part of the country, restrictions start to ease as the vaccine got more and more implemented. So first we're looking at the impact on the business and whether that impact was more than nominal. Because if you don't have impact or you can't document that impact, having all the government orders in the world is not going to help you. So in going through and doing that process, usually what we're doing, we can do that in varying degrees. We can either collect information from the client if we feel like it's just a little simple discrepancy. If we feel the client has a good claim, they just need to back it up. We'll just get some supporting documents and do kind of a review of that. In more serious cases, we'll actually take them through the process or a similar process to what we would do for a tax opinion letter. If we go through that part of the process and ultimately determine that there is a quarter that should not have been filed for the employee retention tax credit, then there are several remediative measures that we could potentially take. So the remediative measures hinge on the question of, has money been received? Has the client gotten a check from the IRS for the credit, or is that credit still in processing? So if the client has not received a check, one of the things that we can do is we can disavow the check. It's as simple as, when the check comes, we would send it back to the IRS with a letter explaining the circumstances, explaining that we don't want the credit, and just mailing that back. Moving to, if the client has gotten the money, then we kind of figure out what the damage control is. So first of all, there's no affirmative duty to re-amend an amended tax return. And so immediately we are faced with a choice, or the client's faced with a choice of, do we let this ride and potentially deal with the consequences of an audit later, or do we want to be proactive and get in front of this? Being proactive and getting in front of this can take a couple of different directions. Most commonly what we would do is probably re-amend the return, explain that we've done a review of the process. We would write something similar to what we would write for a penalty abatement with the IRS, although preemptively, no penalty has been assessed in this particular case. And then we would basically mail the check back to the IRS, or the money back to the IRS that the client got, with a little bit of interest, and say, hey, we're sorry, we shouldn't have claimed this, and here you go. That process, although new for employee retention tax credits, that's something that we refer to in the tax community as what we call quiet disclosure. So we're fixing a problem not through necessarily a formal channel, but through an informal channel by saying, oops, we filed this, we shouldn't have, we're giving you the money back, no harm, no foul. In most types of cases, that will remediate the need or eliminate the need for the IRS to come in and do an audit. Moving forward, if we've got issues with multiple quarters, or if we have amounts that are fairly substantial that were paid out and shouldn't have, then we have what we consider to be a much larger problem. Again, there is the decision of whether we disclose this to the IRS proactively, or whether we wait for an audit and deal with it then, but also assuming that we want to be proactive. We might submit under the domestic voluntary disclosure procedures. So the IRS has a series of procedures that allow taxpayers who have made a mistake, either in the criminal context or in the civil context, to get out in front of their mistakes and to do a formal submission. Usually by going through the domestic voluntary disclosure route, it's sort of your ticket out of certainly the criminal side of things, although most ERC cases will not be criminal, but also the more severe civil fraud penalties, the 75% penalty most notably. And by being proactive, depending on the facts and circumstances, you can usually take a lot of the more serious consequences off the table. The downside with the domestic voluntary disclosure process is that it requires full transparency and for you to come forward. So it's not a situation that you would go into where you say, well, I'm going to disclose one quarter and not the others. Chances are it will either trigger an audit or some sort of internal review, or at least it suggests the possibility that that might happen. So there's some advantages and disadvantages, and the full spectrum of that depends on the client's facts and circumstances, and quite honestly, they're a little more nuanced than we're able to cover on a short video. But hopefully that gives you the framework for making decisions when it comes to employee retention tax credit compliance.